A mortgage is the biggest loan most people will ever take in their life, but most people pick one without understanding the difference. Let's fix that. Every mortgage type, explained simply. Fixed rate mortgage. A fixed rate mortgage means your interest rate stays exactly the same for a set period of time, usually 2, 5, or even 10 years. So if your rate is 5% today, it stays 5% the whole time, even if interest rates in the wider economy go up. This means your monthly payment never changes during that fixed period, same amount, every single month, no surprises. The biggest benefit is peace of mind, because you know exactly what you are paying, so it is easy to plan your budget around it. The downside is that if interest rates drop after you lock in, you do not benefit from that drop, you are stuck with your fixed rate either way until the term ends. Most people choose a fixed term of around 2 to 5 years before reviewing their options again. Fixed-rate mortgages are the most popular choice for people who want stability and hate surprises in their monthly bills. Variable-rate mortgage. A variable-rate mortgage means your interest rate can change over time. It moves up and down based on the lender's own rate, which usually follows the wider economy. If interest rates in the economy go up, your rate goes up and your monthly payment increases. If rates go down, your payment can decrease too. This means your monthly payment is unpredictable. Some months could be cheaper, some months could be more expensive, and you will not always know in advance. The benefit is that variable rates often start lower than fixed rates, so you might save money in the short term while rates stay low. The risk is simple. If rates rise sharply, your payments can become a lot more expensive, sometimes without much warning at all. This option suits people who can handle some uncertainty and want flexibility instead of locking into a long-term commitment. Tracker mortgage. A tracker mortgage is a specific type of variable mortgage. Instead of following the lender's own rate, it directly follows a public interest rate, usually the central bank's base rate. For example, your rate might be set at the base rate plus 1%. If the base rate is 4%, you pay 5%. If the base rate moves to 5%, you now pay 6%. The key difference from a regular variable mortgage is transparency. You can literally watch the central bank's rate and know exactly what is happening to your payments and why, without guessing what the lender is doing behind the scenes. Trackers tend to move immediately when the base rate changes. There is no delay and no hidden decision from the lender. Just like a variable rate, this comes with risk. If the central bank raises rates several times in a row, your payments can climb quickly within a short space of time. Trackers are popular when interest rates are expected to stay low or fall, because you benefit immediately from any decrease without having to apply for a new deal. Offset mortgage. An offset mortgage is a clever one. It links your mortgage to your savings account. Here is how it works. Let's say you owe $200,000 on your mortgage, and you have $20,000 in savings linked to it. The bank only charges you interest on the difference, $180,000, instead of the full $200,000. Your savings are not used to pay off the mortgage, they are simply sitting there, reducing the amount you get charged interest on, and you can still access your savings whenever you need to. The more savings you keep in the linked account, the less interest you pay overall, and the faster you can pay off your mortgage without making any extra payments. The downside is that your savings usually do not earn any separate interest while they are offsetting the mortgage. You are trading potential savings interest for a reduction in mortgage interest instead. This works best for people who keep a healthy savings balance and want to reduce interest costs without locking their money away in a separate account. Interest-only mortgage. With an interest-only mortgage, your monthly payment only covers the interest on the loan, not the actual amount you borrowed. This makes your monthly payments much lower compared to other mortgage types. But at the end of the mortgage term, you still owe the full original amount you borrowed in one lump sum, with no reduction at all. This type is often used by property investors who plan to sell the property later, or pay off the loan with a separate investment they have built up over time. It can also appeal to people who expect a large lump sum in the future, such as an inheritance or a bonus. It is risky if you do not have a clear plan to repay that final lump sum, because the full debt does not shrink on its own. Repayment mortgage. A repayment mortgage is the standard type most people picture when they think of a mortgage. Every monthly payment covers two things, some of the interest, and some of the actual amount you borrowed. In the early years, more of your payment goes toward interest. In the later years, more of it goes toward the actual loan. Over time, you owe less and less, until the mortgage is fully paid off by the end of the term and you own the property outright with nothing left to pay. This is the safer, more common choice, because you know that by the end, the debt is completely gone with no lump sum waiting for you and no surprises at the finish line. For most people buying their first home, this is the type that gives the most peace of mind over the long run.